All right, guys, welcome back for another video. In this video, I just want to do a very deep dive on price action in Bitcoin and kind of start from the weekly and work my way down. So what we're seeing now in price action is very, very significant. We've never tested a previous all-time high from a previous bull cycle, and we've also never confirmed weekly divergence on the RSI. So two very unique historic things happening in the Bitcoin market. And now let's go down to the weekly to the price action over here and explain exactly why I think the weekly divergence is confirmed. Well, the divergence is confirmed once you start taking out the weekly highs, right? Now, a lot of people, they may not necessarily look at it that way. They may be looking for a close above the high. And there's no right or wrong way to do it. I'm just going to try to make the argument for why, it is valid to use, just simply trading above the high as a confirmation. It's a little bit more cavalier of a confirmation, but in my opinion, it works better than necessarily demanding a close above the level. So again, the RSI is the weekly RSI divergence is this weekly low relative to this weekly low. So here's your capitulation in Bitcoin, this major candle here, and then this other push down. So you got your capitulation lows right there. And then you get a lower low testing these capitulation lows, probably on lower volume. If you were to put on the volume, lower volume relative to this one. But doing it and building divergence, right? And then you test down to that level, and then you start taking out the highs right here. So if you go down to the daily chart, you'll see kind of that in a little bit more detail. This high is significant on the weekly. It's going to be significant on the daily. It's going to be significant on the 4-hour. Because it ties back to the Federal Open Market Committee on September 21st. We'll talk about why that's important going, down to the lower timeframes. But first, I want to start talking about the daily divergence. So you've got these series of lower lows right here, and you've got the series of higher lows on the daily RSI. So again, this one's not like significantly higher, just barely higher than this one, but it is a series of higher lows on the RSI. So you got boom, boom, right? Higher low, lower low, lower low. And then this is kind of where, things start turning around right here after FOMC. So let's go down to the 4-hour and really the hourly. And you can kind of see how the time frames weave together, right? So remember, these are your daily lows and your daily RSI. And then you can kind of see, this thing, start to the lower time frames kind of line up with the higher time frames, right? So you get your final daily low, and then you also get bullish divergence on the 4-hour, right? As that FOMC low gets put in right here, then bounces up. Now, what is the FOMC low? Well, here was your Federal Open Market Committee, where the Federal Reserve spoke and released their monetary policy. The data hit the market right here, roughly right there on September 21st. You get a major, major push up above these highs right here, right after the data release, and then throws above, grabs liquidity above these highs, and then runs down, throws below these lows right here, grabs liquidity, pumps back up, and then you get another run for liquidity below these lows right here, and there's your swing low. That's your absolute low, right? At this point, you have weekly bullish divergence, daily bullish divergence, 4-hour bullish divergence, hourly divergence, probably even 15-minute divergence. So, it's very characteristic of those areas of the market where everything lines up for all the different time frames to kind of, line up in the same direction. So it's not a trending environment, right? All the time frames are not trending. We're kind of at support. But you do have the same, divergence pattern playing out at support, right? So it's not a trending environment, even though all the timeframes are lined up. It's still showing you the same thing, right? So kind of validating that same idea that we have. And so really I want to mark off this is like the significant level, right? You get this volatility spike from FOMC, and then what happens? Well, get basically a run up to a 618, run up to the 618, sell back into the 618 right here. So this is very tradable, right? Anytime you get a volatility expansion, you can hedge at the 618s. And then a lot of times what will happen is if you get a volatility expansion like this, price will run up to this 1618 and run down to the other 618. And then, you know, there are a multitude of scenarios that can happen from here. But typically what happens after that, after your volatility expansion, is that price will, enter a period of volatility contraction before another expansion. So if you have these two hedges here, a lot of times, it'll enter a period of volatility contraction within, around the median point of the range, right? And you got hedges in premium on both sides of the range. So, so you get your hedge here, and then let's see what happens here. So yeah, you actually get that kind of that distinction. Not, you get volatility contracting, makes one more run down for the low. But if you if you had bought here, sold here, then, this whole time is price is just, contracting. This is really not a great place to trade, right? You don't want to trade within the range. This is really the time to sit tight. But then, of course, when it enters that period of volatility contraction within the range, and starts breaking to the upside of the range, then the hedge that you pulled off here, maybe you're managing risk above these levels right here, but you could pull that off, right? And then you got the lower leg here, and that this push up ends up actually being a throw over above the liquidity over here. So you get a push up above this level, and then a run down below. So, I mean, this is just brutal market behavior, right? So, these highs get run, then these lows get run right here. Very, very volatile market, at least within the support range that we're in currently. So let's see if we ran up back into a 618 right here. Yes, we did. So we ran up into a 618, ran down into another 618. So we've got the same type of pattern going on right here. This could take its time, or it could play out pretty quickly. We don't know for sure. Again, this is another very, 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 very technical pattern playing out here, right? You get a price extension fill from this level roughly to this level. Just make it clean right here. Let's see. Fuck it. But you get test up into this level, test back down, then break above. So price extension fill, come back down, break above. Once it breaks up above into this area right here, then it pushes up much further, fills the inefficiency void up here into the 618, comes back down into a 618, and then starts pushing up. This, again, now we're back in the middle of the range after volatility expansion and tested both sides of the 618. This is not a great time to be taking trades. Although I guess you could go down to, like a 5-minute chart, trade this. Even within there, right, this is very tradable, right? Probably had a 618 retracement right here. Yep. Right into that level, bounce up, run for the liquidity above this level right here. Again, it's not perfect. I generally don't like to get caught up in the weeds, especially, in an area like this where on the big picture, really, we're just, just contracting, right? Volatility is contracting, at least on the high time frames. So I really want to keep that in mind. The time to really get down and dirty on the low time frames is sort of when you get a volatility expansion. Oddly enough, because when you get a trending volatility expansion, the price is moving generally in one direction, right? So while it is moving in a very volatile fashion, it's actually not doing a lot of retracements and not whipping around, right? Like sometimes you see it in the ranging price behavior. And what that means is that, you can play the low timeframes without, play very tight onto price without, price necessarily running your stops or, whipping you out of positions. So anyway, long way of saying this is not the time to be playing the low timeframes. Really, what we want to see here is we want to see, if we are bullish, we want to see this, the trend kind of turn around, right? So what would have to happen? Well, we've got weekly divergence right here. Let's see what the EMAs are doing. Yeah, the EMAs are still kind of fucked at this point. Let's see what the 3-day. Yeah, not any better really. Daily charts looking a little bit better. Yeah, you've got your break of structure right here. Then you get your break of structure. Price kind of coils up into the change in the EMAs and then gets one last spit down. Then you get a pump back up into this break of structure. But notice that a lot of times these pumps, they're a little bit immature, right? They're not reflected in the formation of the EMAs, and a lot of times those will get retraced, right? But if we had, at this point, the EMAs have kind of, their slope has gotten far more neutral than it was during this point, right? Here it's much steeper than it is right now. These are starting to curl around. So if you did get another pump like this, it's very likely that at this scenario, the EMAs would start to turn around and you would end up with a break of structure, similar to what you had over here to the downside. Now, of course, it's not a guarantee, but you are seeing, some things kind of turn around on the lower time frames. You've got the 4-hour right here. Again, this is really the time when EMAs are absolutely the worst. You can see here that, I've still got my position open from the FOMC meeting a week ago. Down here, I was the buyer down here, right below these. Well, not quite below these levels, but right at these lows over here when liquidity got ran over here. Grabbed this position. I've been sitting in this position for a while. I don't really see any reason to exit the position. I'm very bullish on the the higher time frames in particular. Let's see what's going on. Yeah, it's worth mentioning the stochastics. I know I don't really talk about stochastics all that much, but they are kind of turning up a little bit here. Weekly's turned down, 4 hours turned up. Yeah, it's not the best. Again, this is just ranging market behavior, not the holy grail of stochastics or EMAs. So, what would have to happen for Bitcoin to really mount a rally? Well, we're kind of at the early stages of what would be or could be a rally, right? We're capitulating into a very significant historical level and then putting divergences on. This is generally where you convince sellers to step into the market, and then the sellers get squeezed at the lows, and then that's when the trend really starts to turn around a little bit. So, for me personally, seeing the FOMC high get taken out for me was a big green light that this market is going to the upside. But a lot of people, of course, would want to see this high taken out. If you're just going from a textbook, trend is trend standpoint, then you're going to be looking at that. But seriously, I very strongly feel that this high set in during FOMC. Once I saw this move above here to run liquidity above there, I started, having a great deal of conviction in the existing trade I'm in. Even though price kind of retraced significantly towards my entry. The reason for that is that, after the FOMC meeting, right, you had a flush of the game board, so to speak. You had a run to the upside and a run to the downside. So this is your new range after the FOMC. And so price really has a choice, right? If it's still bearish, then you would expect price to run liquidity to the lows, right? That's what bearish trends do, right? They run liquidity to the lows, pick those up before really pushing down lower. But then when you see liquidity run to the upside, showing you a change of behavior, it's probably going to become the very beginning etchings of a trend. Very, very early signs, right? Of course, you would need to take out this high again to confirm a bull trend on the 4-hour. And then this area to control to confirm a daily uptrend. You'd have to, actually, no, because you would need a high. So you need to take this low out, take this high out, and then come back and set a higher low. So problem is that, the problem with trend trading in this fashion is that it's very difficult to manage risk on these type of positions, right? Because say, for example, price did come up above this level right here, and you're trading a daily trend model. Well, okay, now you're going to be waiting for a higher low to form. In Bitcoin's, Bitcoin, when it starts moving, it really starts moving, right? It's not going to come back down and give you the perfect higher low entry, right? A lot of times when Bitcoin pumps, it'll just take out the highs and continue to just pump and take out the highs without setting in a low. And then there's all different levels you can go, right? You could, if you're waiting for a weekly trend confirmation, you would have to wait for this one to get taken out, right? And at that point, right, when these highs get taken out, Bitcoin probably pumps pretty significantly up into this liquidity above here. So if you're doing the textbook trend-based model trading, a lot of times you'll be on the sidelines during the pump, right? You won't even get a position, and by the time you do get a position where the market comes back and sets in what looks to be like a higher low, a lot of times that's not a great entry, and a lot of times that'll just get sold into. And nothing against trend trading, but it's just not really the phase of the market that we're in right now, right? This is the exhaustion phase of a bear trend. So again, you can see some pretty dramatic stuff here without anything earth shattering, right? If we go back to previous phases in the market cycle when Bitcoin was at the weekly 200, you can see that it rallied off the weekly 200 into a 618. Perfect. Let's see what would happen if. So you could either take this high, right? This is a very significant high right there, down to the capitulation lows right there, and that would bring you up to 36,000 roughly. That would fill this liquidity void up there. Or you could even take a higher level view and go for the full swing, right? The absolute top to the absolute bottom, capitulation bottom right here. And that gets even more interesting because then your 618 comes directly above these highs. That would be the liquidity run of all liquidity runs. If you get that type of move, that would be pretty significant. I wouldn't say I would be surprised to see that, but I definitely wouldn't be surprised, but it would be quite the move. I'll say that. And a lot of times in Bitcoin, we do underestimate the capacity that Bitcoin has to perform in ways that shatter expectations. So whenever I'm trading Bitcoin, I always leave the door open for some of those less probable, less realistic, as some people might call them, scenarios, but still highly probable. At least in Bitcoin, with an asset with an inelastic supply, crazy shit can happen, and you always want to leave the door open to that possibility. Anyway, I hope you guys like this video. If you do, just leave a like on the video and subscribe to the channel. I'll catch you guys in